biggest mistake most investors make isn't buying bad companies. It's buying great companies at bad prices. My name's Carl, and my strategy is simple. I buy high quality, wide moat compounders, but only when the market gives us a temporary discount. I hold them until the fundamental narrative changes, not when the stock price wiggles. If you're tired of chasing moonshots and want to build a portfolio of businesses that actually dominate their industries, you're in the right place. Today, I'm showing you my first 3 stock picks that I'm buying for 2026. Zoetis, Thermo Fisher, and VRSK. These aren't just stocks, they're toll booth businesses, currently trading at a rare valuation gap. Let's take a look at the math. First up, Zoetis, ZTS. In the world of animal health, Zoetis has no equal. They are the 800-pound gorilla in vaccines, medicines, and diagnostics for pets and livestock. Think about the humanization of pets. In 2026, we don't view our dogs as animals. They're family members. People will skip their own vacations before they stop paying for their pet's life-saving medicine. This creates a recession-proof revenue stream. Historically, the market has paid a massive premium for Zoetis, usually around a 38 PE ratio. But right now, we're looking at a PE hovering near 20 to 22. Why the drop? There's been noise about a slower rollout for their pain products. But the core business grew organic revenue by 6% last year, and they just hiked their dividend by another 6%. We're getting a world-class leader at a 40% discount to its 5-year average. I'm scooping this one up while the short-term thinkers are worried about quarterly fluctuations. Stock number 2 is the backbone of the scientific world, Thermo Fisher Scientific. If you're a biotech company or a hospital, you physically cannot operate without Thermo Fisher. They provide the picks and shovels, the lab equipment, the chemicals, and the software. They aren't betting on which drug will win. They win regardless of which company finds the cure. TMO is an acquisition machine. They just closed the Solventum purification deal, adding another $1 billion in annual revenue. They are currently outperforming 90% of their peers in free cash flow growth. TMO almost never goes on sale. Its 5-year average PE is typically 34. Today, we can grab it closer to 30. While that doesn't sound like a crash, for a company of this quality, it's a massive opening. In 2026, analysts expect earnings to jump another 8%. By buying this now, we are locking in a high-quality yield on cost before the market realizes the biotech hangover is over. Finally, my favorite hidden play, VRSK Analytics. VRSK is the ultimate toll booth business. They provide the data that insurance companies use to decide how much to charge you. If an insurer wants to know the risk of a hurricane in Florida or a car crash in Texas, they pay VRSK to find out. They have a virtual monopoly on this data. Data is the new oil, and VRSK owns the refinery. Their revenue is incredibly sticky because an insurance company can't just stop using their data. They'll be flying blind. VRSK's 5-year average PE is a staggering 45. Right now, it's trading at 34. The market is focused on some minor interest expense increases, but they're ignoring the fact that VRSK just delivered 40% free cash flow growth. This is a top-tier compounding machine trading at a B-tier price. This is exactly the kind of setup I look for. A temporary narrative clouding a permanent business advantage. So the strategy for the start of the year? Buy the best, but only when it's on sale. And this year, we're starting with ZTS, TMO, and VRSK. These are the cornerstones of my portfolio as I head into the new year. Now I want to hear from you. Which of these 3 do you think has the most upside this year? Or is there another compounder on your radar? Drop a comment below. I read every single one. Make sure you hit subscribe to catch my top 3 next week. I'll see you in the next one.